All right. Welcome, everyone, to another episode of TradeView Live. I'm your co-host, Ben Tracy here. I lead business development at Vizion, joined here by my fellow host and our CEO and co-founder, Kyle. All right. It's been a few weeks since we met. We appear to be post-peak season. There's a lot of topics we want to talk about in terms of breaking down peak season, breaking down bookings demand and pressure indices, lots of new insights to share with you all. Before we do that, we probably have some new viewers and attendees on the call today, and we want to explain to them a little bit about what we'll be discussing. So TradeView. Kyle, what is TradeView?
Yeah, so it's called TradeView Live, but TradeView is a product line here at Vizion, and it's the industry-leading trade intelligence platform. So predominantly focused on ocean freight, but we see nearly 60% of all the ocean freight in the world on this platform, 3 times more than any other solution out there. We also see 2/3 of that as a leading indicator, so understanding it from the time it comes in as a booking request. We did the hard work to profile all the businesses behind these shipments, et cetera. So 1.5 million company profiles and providing trade forecasts for every company, every product, kind of any way you want to pivot the data. And this allows us to also provide amazing supplier and product networks because we have 12 years of this information. And if you don't have the time to sift through 12 years of this information, there's an AI researcher built in where it will just answer your questions. So TradeView helps us power TradeView Live.
So it's a lot of data that we source and parse through. Where does it all come from?
Wide variety of sources. We've built more than 270 proprietary data connections in the past 6 years. Carriers, ports, terminals, carriers of all modes, rail, ocean, road, air now as well. Pulling in data from the public domain, customs information, vessel tracking, licensing, AIS information, all sorts of different data sources that are, highly fragmented and aren't easily stitched together. But we did that tough work and can use it to not just tell you what has happened, but what will happen.
And what will happen? I think many different data sources out there look at lagging data sources. So what allows us to look at what's planned and what will happen in the future?
Yeah, we're certainly steeped in the lagging data sources, having built our careers using those types of tools and data sets. But it always left you wanting to know more about what was coming, and so that was a key priority in building TradeView. And part of why we can forecast the future is that we've been able to build access to an extremely large volume of ocean freight bookings and booking requests that are generated worldwide every single day. Close to 40 some odd % of all the booking requests generated worldwide every single day. And a booking request will later become a booking, which will become a bill of lading, which will become an active container shipment, which will take several weeks to be delivered. And so this allows us to see weeks into the future about what will depart, what will arrive, et cetera.
Wonderful. Well, if there are any questions as we go through this, feel free to drop them into the comments. We'll start with a bit of a deeper dive into peak season. Since the last time we presented some of these statistics, we were still in the month of July. So what kind of peak season did we have? Peak months, it sounds like some of the biggest months in global booking activity that we've seen in quite some time.
Yeah, months that were starting to rival COVID, bounce back era. So, over 10 million TEUs we saw come in as bookings in June of 2026. July, we have here at 10 million. This is, 26, 25% year-over-year growth in terms of bookings and an earlier than expected peak season. I think it's easy to argue that buyers of goods really wanted to downplay any potential risk of the geopolitical sphere and said, let's just get this stuff earlier into our inventories versus risking what might be happening during the time of year when we really need this stuff on shelves, et cetera.
And so speaking of what's going on shelves, a lot of questions we got as we put out these insights to our customers is what types of cargo are we seeing in this peak season and this increase in bookings. So we broke it down by HS code here. It's interesting just to see such a wide array of products intended for consumption, from meat to furniture to vehicles and automotive parts.
U.S. imports focus.
Yeah, we're seeing statistics obviously about June U.S. import arrivals. Again, those are the lagging indicators from customs data sources. We're looking here at actual bookings, and so as arrivals begin to reach their record highs, those will likely continue because it looks like both in June and July, U.S. imports saw their strongest booking months since 2022. Now, where is that booking activity coming from? Very different than that previous peak in 2022. We've reported on this before. This begins back in April of last year, if not before all the tariffs hit. But the increase in U.S. import activity is mostly not due to our relationship with China, but all the other origins. Overall, U.S. imports are up 21%. All other origins up 33%. And then that China to US relationship, which still is a large amount of the imports that come into the US, but it's mainly flat, growing just 2% year on year. Now, Kyle, this breaks down similar to what we saw before, those HS codes, those cargo type categories, but only looking at US imports. So we still see furniture and bedding in there, but footwear and beverages are actually some of the top growing, fastest growing HS code categories.
Get your Nikes and what was it, like the Boston ran out of beer and liquor during World Cup? Get your beverages.
Yeah, it's there's a lot of stock out going on. I read about some of the beverage industries and just what's explaining this behavior in U.S. Import activity. And a lot of this is just front loading of inventory, not necessarily just an increase in consumer demand. I'm sure the World Cup had an impact to it, spending in general during the summer months. But some of this is, hey, let's get all the products in, the ones that are shelf stable, the ones that we can keep in our warehouses under refrigeration for 6 months or more. Let's get them in now before potentially things change.
It's also interesting to see the drop iron and steel articles, electrical machinery.
Yeah, and that's where a lot of the recent tariff activity has been focused on. Yeah. So not a big surprise there.
I also wouldn't be surprised because inflation across the world has certainly hurt producers, but some might argue that it may have hurt consumers more, and so there are major margins being captured by getting consumables to market faster during these inflationary periods.
Yeah, agreed. So quick look here, since we gave you that headline statistic of just the China to US relationship year to date being relatively flat in comparison to last year. But we did want to share in the last couple of months that we do see this uptick mostly commensurate with the peak season. So we do see that beginning to climb up in the last couple of months, but still just 2% year on year in June, and then 15% year on year growth for the month of July in comparison to July of last year. Now, this is where a lot of the growth is coming from, both Vietnam and on the next slide, a different origin. So Vietnam, all-time high for bookings to the US.
Yeah, and compare that in terms of like actual TEU totals. So 650K, China, 661 for June and July, respectively, out of China. But then look at that for Vietnam, 284K, 264K, a surprisingly high ratio compared to what they used to do when China was, the bigger player.
Yeah, nearly half of the volume that we bring in from China now with just Vietnam imports.
And those imports are.
Yeah, we've got the things that we want to buy for the holiday season, back to school. You've got Black Friday, so toys, games, and sporting goods. No surprise to see that. Now, iron and steel, I think, is interesting. Some of the certain exceptions that were made for iron and steel products are probably due to this. And then you've got general categories for machinery and plastics that are used in many different types of goods, electronics, and other parts.
And while we're showing this information as types of products, et cetera, coming from China or Vietnam or elsewhere to the US, I know this time of day we have quite a few people in Europe who are watching. We can also provide this data as it's imports to the EU, same time frame, et cetera. Or if you're in South American East Coast, you might be interested in seeing this as well. But drop us a comment. It's easy for us to do any other cuts of the data within a few minutes, and happy to get that kind of insight over to you.
Yeah. So one other origin we want to dive into here is Cambodia. And I'm recalling that volume you mentioned of Vietnam to US was about 260, 270,000 TEUs for the highest month. Cambodia now coming very close to that amount. So Cambodia and Vietnam, if you combine them together, you almost have the size of our import relationship from China, just from those two alternative origins in Asia. Similar breakdown here. We see some overlap with the categories from Vietnam, such as the furniture and bedding, but that's actually growing faster in Cambodia right now than in Vietnam. Other goods like footwear, I don't think we see as high of growth for Vietnam, but with Cambodia, clearly a lot of shoes are being brought in. So
and
other trade lanes.
Asia to Europe, yeah.
This is where the growth has been continuing for a while and is sustained. In fact, the argument here is that the peak season has actually been a little bit longer for the Asia to Europe trade lane than for Asia to US. So we don't quite have a record-breaking month going back pre-COVID, but certainly the highest month above 1 million TEU since 2021. And it looks like that continued for the most part in July, but more of the year-on-year growth was in June.
Now,
so
yeah. Go ahead. You want to talk about this?
I was just going to wrap up. So that's really our breakdown of peak season. Where we're seeing in a lot of the metrics we're pulling now that we're a little bit past peak season. So the past two episodes we've dove into that. If you have more questions on peak season and the analysis, please share. But for the rest of the time today, we wanted to introduce something a little bit new. We're calling the SDPI.
Yeah, so not just reporting on booking volumes, what's being booked, where is it being booked to and from, et cetera, but leveraging those insights to be able to also provide a sense of how the market is moving and what direction it's moving. So I want to introduce Vizion's SDPI, or it's a supply demand pressure index. It's a daily pressure score for every origin and destination pair for ocean freight, benchmarked to a 12-month rolling baseline. And for this analysis we're about to share, we're just looking at the top 1,000 port pairs by TEU volumes. We were able to see very much more than that, but for the purposes of the lanes people typically care the most about, we'll break it down. Now, a few notes here. We have some labeling we use when we're looking at trade lanes and port pairs for the path or pattern they're trending. There's some which are under severe stress, which is seeing the SDPI above 0.45. Some that are tightening, which is kind of 0.3 to 0.45, and then softening, which is 0.3. There's some key elements here as well. So there's one element which is seeing the demand, the volume of booking requests coming in, but there's also the supply element. And the supply element is a proprietary mixture of several different inputs, some of that being ocean service capacity, looking at vessel assignments, understanding carrier acceptance rates, understanding booking modification rates, seeing the patterns and behaviors of different types of parties across different geographies as well. All this being taken into account to create this pressure index. And generally speaking, what we found is that the SDPI is an earlier indicator of where the market is going. For one, understanding, will you be able to even get that allocation or place that booking? And two, which way will the rate be going? Yep. Earlier than many of the rate indices out there. And so the first thing that's important, and typically what happens is, can you get the space? Is question number one. And to have the best chance, you want to be first in line versus last in line, asking for the space. So this is where the SDPI is helpful, but it also gives you a sense of which way the rate might be going, because honestly, at the end of the day, the rate's going to be the rate. But did you even get the space to have the chance to pay the rate?
Yeah. Yeah, absolutely. So, I mean, I'm really excited to see this as an evolution of just the raw bookings data that we've been reporting on for some time. This has been in the works with our data science team, as you said, blending different ingredients from acceptance rates to vessel capacity, alongside just the amount of bookings that we see each day. And so, ultimately, it's a much more useful and I think a much more precise measure of supply and ultimately pressure on specific lanes.
Now, speaking of that pressure, at a high level, wanted to provide a quick executive summary before we start diving down into lanes and potentially even some specific port pairs. But overall, across all the trade lanes right now, across the 3.1 million TEUs we're monitoring right now, we're seeing across all the major trade lanes that effectively demand is loosening. And so this is why we're also starting to see that rates may have flatlined and or are going to start dropping. And we broke this down to a bar chart down below. So 77% of bookings out there right now are in a loosening market, 14% is in a stable market, and 8.2% is in a climbing market. The tightening right now we're seeing is Asia to the Latin American East Coast. So there's active rationing of space by the carriers on these trade lanes. Some of the rate providers out there are seeing rates getting above $10,000 per FEU. But what this really kind of, I think, highlights is, well, one, what the carriers have been doing with reshuffling where they want capacity on their different services, but also management through blank sailings, et cetera.
What
I do
wonder,
also want to.
I was going to say, I wonder how much the recent announcement from the Panama Canal about draft restrictions could impact that trade lane in particular. I know we also see it impacting Asia to U.S. East Coast as well, but I would imagine Latin America East Coast is similar.
Good call out.
Yep.
And on a similar route, Indian Subcontinent to the U.S. East Coast. So we're seeing the SDPI, Vizion's supply demand pressure index, is peaking at 1.74, which is very, very high in terms of the index, preceding the August 15th kind of peak season surcharge of $5,600 from HAPAG and CMA. We're seeing that as extremely high pressure, tough to get capacity lane right now, but it appears like it may be peaking now. So there is early indicators that it's going to start reversing, but if your allocations are very important to you right now, don't wait. Just go and book it at what it's at, because it's going to still be tight with a slight easing factor. And in terms of easing, Asia to North Europe Mediterranean has shown a lot of easing. So even the Drewry rate from Shanghai to Rotterdam's, the spot rate fell 8%. But we're seeing pretty meaningful easing across Asia to North Europe now, because post-peak season. Even getting back to that chart before, we were showing Asia to Europe in terms of booking volumes.
And the acceptance rate is very high for that trade lane as well, over 85%.
Now, hitting some of the major trade lanes, we try to put all the big ones here onto one slide for you. We ordered by TEU volume that we're able to observe. So like intra-Asia, 920,000 TEUs we're able to observe there. Transpac to US West Coast, it's kind of an early stage directionally. It's it's flat to maybe slightly easing in some sense. The call outs we also wanted to put out there were the Asia to Latin America, a little bit of Asia, West Africa, and Asia to LATAM West Coast are playing out. And as we mentioned, the Indian Subcontinent to the US East Coast are also in stages of concern, with the 7-day spot SDPI being at these 0.76, these 1.74, et cetera.
So it looks like there's a few trade lanes that the softening is confirmed, and then several more where we're at a very early stage of that softening, indicating basically we're past the peak season where rates have been increasing for some time.
That's right. Now the tightening watch list more specifically. So these are specific port pairs that if you're using these, you should be paying attention to this. So the tightening watch list. Ningbo to Newark is tightening pretty meaningfully right now. It's up 12, 13 points in the past 7 days. And it's confirmed. There's always a little bit of lag in terms of carrier acceptance, but the carrier acceptance rates being quite low has already been confirmed here. And you can actually see this in these numbers here, where acceptance rates 50%, 62%, 55%. So Ningbo to Newark. If you're going Qingdao to Buenos Aires, it's also challenging right now to get space and expect rates to be heightened. Jeju to LaGuardia. My pronunciations are awful, so please excuse me. And the few more we have listed here. We also have some additional port pairs that we're seeing the early indications of tightening. We have seen the volumes tick up in terms of request pressure, but it's still early to understand how the carriers are reacting in terms of acceptance and what they're doing to manage capacity on those port pairings. But wanted to call out a number of different sources out of Phnom Penh, so Cambodia, heading to the U.S. East Coast and Gulf, and also Shanghai to Houston and Shanghai to Long Beach are early concerns right now.
Yeah, I like that we can get as precise as these port pairs. We have a lot of customers, shippers, logistics service providers, and the like that they are needing to follow these specific port pairs, not just the trade lane overall.
Now, some good news. Where is it starting to loosen? We're seeing the backhaul from Europe to Asia, so Rotterdam to Nanshan is loosening, and it's been confirmed. Also, the Shanghai to Le Havre is also softening. Shanghai to Santos is also on the softening side. So as we mentioned before, if you're looking at Qingdao to Buenos Aires and you have some flexibility, maybe something like Shanghai to Santos could work for you. I realize there's still quite a bit of land movement that you'd have to fix there, but there is loosening there. Antwerp to the Mediterranean, specifically Ashdod, loosening. Ningbo, and also Ningbo kind of more Asia, Latin America, and intra-Asia, we're seeing some loosening. Just peaked and is showing the early indications of rolling over, meaning it's going to have a touch of easing. We have a variety of different port pairings here, but a lot of Transpacific to East Coast U.S., West Coast U.S., looking at out of Thailand, looking out of Haiphong with Vietnam as well. Also looking at Asia to Latin America again.
And that Shanghai to Houston, I think in particular, is one to watch, referencing the Panama Canal and potential restrictions there. But it does look like overall for all of these, we're just past, and in literally less than a week past the peak demand that we would expect.
And also what's interesting is while we've confirmed these, the demand is quite high, but the acceptance rate is also quite high. So that's part of why this is peak but rolling over. Because when you start to see carrier acceptance rates of this height, it's usually meaning that the supply and demand is coming closer to equilibrium than spreading apart like you would with high demand pressure and low carrier acceptance supply.
Exactly.
Just bottom, but reversing. So Asian to Latin America for Ningbo to Peru, Shanghai to Peru. Ningbo to Genoa, Italy is an interesting one. So that's an opportunity for some companies that might want to route through Italy to get to North Europe later. Haiphong also to Peru. But these are not necessarily high volume port pairings, so may not be applicable to everyone, but just wanted to call out where we're seeing hit the bottom, but is now reversing pressure.
Absolutely.
So what to do in the next 14 days? Well, lock now your Transpac to the U.S. East Coast Gulf. Also lock in your Asia to Latin America. I'd wait a little bit longer in Asia to North Europe or Asia to Mediterranean. Those are slightly softening. You might be able to secure better rates and capacity if you can wait a few weeks. And then we'll continue watching the Transpac to the U.S. West Coast, and more specifically Cambodia to the U.S. East Coast and Gulf acceptance, because there's some decent volumes. And as Ben was calling out earlier, we're talking about volumes that are comparable to Vietnam export volumes, with Vietnam and Cambodia combined being nearly what China is sending to the U.S. right now. So this is a hot spot to keep watching.
And so I think this has been a really great example of the data behind the SDPI. As you know, the bookings and breakdown that we've offered over the last year and a half, and now this new sort of index. But that last slide you were sharing goes into some of the actual tactical recommendations that we're offering to customers as well. And so it sounds like there's lots of different ways that if you're interested in this supply demand pressure type data, different ways you could receive it, right, Kyle? We can offer it via API, via data share, or via actual tactical recommendations from our analysts as well.
And very soon in the BoxTrack 2 app as well. So if you're a BoxTrack customer, you'll be able to start tapping into some of this data via UI.
Absolutely. So if there's more that we could offer in terms of this new supply demand pressure index, you have questions on how it's calculated, or do you want different analyses for different lanes, please let us know. All the feedback has been helpful. Otherwise, this wraps up this episode of TradeView Live, and we'll see everyone again in 2 weeks.
Thank you all. Cheers.
Bye-bye.